Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer. The show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. I'm here with Craig Jeffery, Managing Partner of Strategic Treasurer, to talk about four-letter insurance. Welcome, Craig.
Welcome, John. I didn't know it was going to be called four-letter insurance, but it sounds good. I'm excited.
So what kind of insurance are we talking about today?
We're going to talk about FDIC insurance and SIPC insurance.
Very cool. Actually, next week we're going to get into SIPC, so there's a little sneak peek for you. This week, can you start us off by telling us what is FDIC insurance?
Sure. So FDIC stands for the Federal Deposit Insurance Corporation, and this is a type of insurance that protects balances kept at banks and credit unions. It's a mechanism to provide comfort and assurance to depositors so they keep their money in banks as opposed to pulling it out and holding cash, which can be very unsafe because people can steal cash, but it also provides stability in the banking industry because you know you're covered. There's a backstop behind your bank. And if you go back to the Great Depression, 1929 onward, where there were massive runs in the bank, people would line up around the block and they would withdraw their $500 or $1,000. They'd continue to do that until the bank ran out of cash, and then it would become insolvent. And there was a significant panic. And that creates a problem because now everyone holds their cash, and it eliminates or reduces the ability for the economy to operate well and efficiently. So this provides greater assurance to most people, keeping your money in the bank as opposed to under the mattress, in a box, in pipes that are sealed shut and stored in your foundation.
So what type of deposits do they insure? Is all cash protected?
Well, in a bank, this would be things like your checking account or demand deposit accounts or DDA accounts, whichever you prefer to call them. It would cover savings accounts. It would also cover certificates of deposit. I think those are all the ones that are covered at financial institutions.
And what's not covered?
If you have some type of brokerage account at a bank, because there can be a separate entity that handles brokerage activity, let's say a institutional money market fund or something like that, that wouldn't be covered by FDIC. There'd be other types of insurance coverage that would provide some types of protection, not the same as FDIC, but when you look at bank deposits, what's the stability for it? I have a CD, a savings account, or a checking account. It's bank guaranteed, can't lose value, and it's FDIC insured. So there's these levels of protection. Money that's not in those does not have that type of coverage. And there's also limits. So per tax ID, the level now is $250,000 US coverage for any depositor. So if it's a joint account, you have $500,000 worth of coverage based on the tax IDs. If it's an individual tax ID, the total of your accounts are protected up to $250,000. Above that, you face a risk. If the bank goes under, you may not get all your funds back if the bank becomes insolvent.
Does that limit double if you have two banks, or it's for the tax ID?
It's per tax ID per financial institution. So it's if you have $500,000, you keep $250,000 at two separate banks, you have $500,000 worth of coverage, $250,000 per tax ID per financial institution. We talked about broker deposits a few months ago, and that's where someone puts in, let's say, $5 million, and it goes into deposit into 20 different banks. It has complete coverage, complete insurance coverage, but it's spread out among those banks, and then you pull it, and through this overlay type of account, you have coverage there.
Okay. You were talking about what's not covered. I've seen recently a lot of, investing or trading apps. Now they have it so you can just hold cash in them. I don't know if those are FDIC insured. You can send like $50,000 and have it not invested and earning interest within Robinhood or something, but I don't know if they have FDIC insurance in there or not.
Yeah, without endorsing Robinhood or any other services that you talk about, you'd have to look at it individually. If you're sending money into this organization, Are they putting it with an institution or a bank that has this type of coverage? That would be disclosed. You'd want to make sure you read that to make sure you're protected. I mean, unless it's an inconsequential sum of money and you're just trading for fun, you may not care about that. But I would think any of those that you would look at seriously, you would want to make sure that they have an arrangement where it's also FDIC insured for your cash balances.
Okay. So this doesn't cover any investments or...
No, it doesn't cover investments at all. There's really insurance things that we're going to be looking at and what those coverages are. None of these cover the losses that you can bear from, let's say you invest in a company, you have stock, and the value of that stock goes down. We're not talking about any insurance that covers that. That would be something you bear as part of the instrument. There's ways that people can relieve themselves of some of that exposure, but that's not in this type of insurance coverage.
Okay, gotcha. What's the benefits and limitations of FDIC?
Yeah, so the benefits are much smoother running banking system because people aren't paranoid and pulling out small amounts or all of their money from the banking system. So it keeps it in there so it can be secure and work well so that money can be relent and be more efficient. That also protects people from losses, up to the limitation. What are any of the limitations? It's the amount over the portion that's insured. That's one aspect. The other limitation I would say is there's a moral hazard. You can put money in a bank that might pay you a higher rate of interest because they're in trouble. And you don't care up to $250,000 because you're going to be completely covered. You might care about an operational breakage or interruption, but you may not care as much and may not do as much due diligence on your counterparties if you're a business and you keep less than $250,000. But that's probably the only limitation of it.
Okay. The big question is, how do they fund their operations?
So they provide assessments against banks based on their balances. So there's certain ways they charge banks for all of the funds they have because there's an insurance coverage. So those banks have to pay that insurance coverage over time. If the FDIC fund goes negative or runs out of money, they would tap the U.S. Department of Treasury, borrow money from that, and then pay it with the different assessments as they come in. So there's a backstop to the backstop.
Okay, so there's a rate for a bank to join and have coverage, like a monthly rate that they're paying into.
Well, it's based on deposits, so it's not necessarily a monthly rate, but it's based on their deposits. I'm not sure the frequency of collections. That's a good question. I don't know how often the assessment occurs, but it's based upon the balances that they maintain, because ostensibly there's a relationship between the safety of the bank and the level of balances they have that go into the insurance. So it's just a way of assessing a fee.
Is there anything else you want to share about FDIC insurance?
Yeah, I think it's interesting to know that it protects the principal and interest that's earned. And just because if a bank goes under and someone has uninsured deposits, FDIC may still cover it. They may choose to cover it. There may be a way of covering it. But that's always a risk that if you have more than that, that could be an issue. So we looked at some of those incidents that happened back in 2023 where some banks went under, became insolvent, or were picked up by other banks. Nobody lost money, but there was a great deal of concern, particularly with Silicon Valley Bank. When companies were worried about payroll, they had huge sums of money at one bank, and then $42 billion was wired out in one day. And then people are like, how are we going to make payroll? All our money's there. Now it's frozen. There's no access.
Yeah, you'd think they'd have incentive to cover over their limits if they can, because isn't their main priority to keep people's faith in the banking system?
That is one of their key things, is to provide a certain measure of faith in there, but it's also meant to protect smaller depositors. So if you've got $50 million, you're not usually considered a small depositor, should be more sophisticated. Yet they will try to backstop that. During the Great Recession, in 2008, 2009, they went ahead and raised the limit to unlimited balances on these accounts. So there was no worry about, I've got to pull stuff out of these banks that I consider a threat. And so they kept it unlimited for a time. And then eventually it came back down to, instead of 100,000, it came down to $250,000 at 250,000.
So if things go wrong, unlimited funds.
The guide rails that people put in place when they plan oftentimes get overridden because there's a concern that there's going to be a different issue, but you can't depend upon that. But I mean, that happens all the time. Every time things come about, they usually try to override them if they can. And there's some reason given for that.
Well, thanks for sharing your insights, Craig. And to our listeners, remember to tune back every first and third Thursday of the month for a new coffee break session. Thanks.
You're welcome.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.